The International Monetary Fund projects that the U.S. economy will grow by 2.7% in 2025. This growth is not guaranteed. Former President Trump's trade policies continue to have an impact. The tariffs he imposed on steel and aluminum continue to fuel inflation. This creates uncertainty in monetary policy. Investors are closely watching for upcoming data releases. These include the Consumer Price Index, retail sales figures, and industrial production numbers. These figures will provide further clues about the health of the U.S. economy. Despite the challenges, there are also signs of strength in the U.S. economy. The unemployment rate remains low, hovering around 4%. Inflation has also begun to cool down from its peak in 2023. However, concerns remain about the impact of rising interest rates on consumer spending. The Federal Reserve has been aggressively raising interest rates to combat inflation. This could potentially slow down economic growth. The performance of the stock market reflects this uncertainty. The S&P 500 and Dow Jones Industrial Average have both experienced volatility in recent months. The U.S. economy is at a critical juncture. The growth projected by the IMF is contingent on several factors. These factors include the effectiveness of the Federal Reserve's monetary policies. They also include the resolution of trade tensions. Additionally, consumer confidence plays a crucial role. The coming months will be crucial in determining the trajectory of the U.S. economy. European stock markets are painting a picture of robust growth. Major indices have recorded impressive gains. The Stoxx 600, a broad index representing European companies, has seen a significant uptick. This positive trend is fueled by several factors. The Eurozone economy is showing resilience. The recent ceasefire agreement between Russia and Ukraine has boosted investor confidence. This has led to a surge in the value of the euro. Despite the positive market sentiment, challenges remain. The European Central Bank, ECB, is grappling with inflation. It is carefully considering its next moves regarding interest rates. The upcoming ECB meeting will be closely watched by investors. It will provide insights into the ECB's monetary policy stance. Another key indicator to watch is the Purchasing Managers' Index, PMI, data. This data will offer a glimpse into the health of the manufacturing and services sectors. The European economy is navigating a complex landscape. It faces headwinds from geopolitical uncertainties and inflationary pressures. However, the recent performance of the stock markets indicates optimism. Investors are hopeful that the ECB will successfully manage inflation. They are also optimistic about the positive impact of the ceasefire in Ukraine. The coming months will reveal whether this positive momentum can be sustained. Asian markets are sending mixed signals. China, the region's economic powerhouse, is adopting a moderately flexible strategy for 2025. This approach involves a combination of monetary easing and fiscal stimuli. The goal is to support economic growth while addressing challenges in the property market and local government debt. Despite these challenges, China's economy continues to expand, with its GDP growing by 5% in 2024. However, other major economies in the region are facing headwinds. Japan is grappling with economic stagnation. It is struggling to revive its economy amid weak consumer spending and deflationary pressures. South Korea is facing political tensions. This is creating uncertainty for businesses and investors. These divergent trends highlight the complex economic landscape in Asia. The performance of Asian markets in 2025 will depend on a variety of factors. These include the effectiveness of China's economic policies, the ability of Japan to overcome its economic challenges, and the resolution of political tensions in South Korea. The geopolitical situation will also play a significant role. The ongoing trade tensions between the United States and China continue to cast a shadow over the global economy. The geopolitical landscape is undergoing a period of profound transformation. This shift is having a significant impact on global financial markets. The breakdown of multilateralism and the rise of protectionist policies are creating uncertainty. This uncertainty is making investors nervous. The coercive nature of U.S. foreign policy, often perceived as prioritizing U.S. interests above global cooperation, is adding to the complexity. The growing influence of China and Russia is also reshaping the global order. This shift in power dynamics is leading to a more multipolar world. However, it also raises concerns about the potential for increased geopolitical competition and conflict. This uncertainty is reflected in the volatility of oil prices. The political instability in the Middle East, particularly the power vacuum in Syria, is further exacerbating these concerns. The integration of cryptocurrencies into traditional financial systems adds another layer of complexity. While cryptocurrencies offer potential benefits, such as increased financial inclusion and faster transaction speeds, they also pose risks. These include regulatory uncertainty and the potential for market manipulation. Central banks around the world are grappling with how to regulate this emerging asset class. The global financial system is facing a confluence of challenges: geopolitical instability, rising protectionism, and the emergence of new technologies like cryptocurrencies are all contributing to a period of heightened uncertainty. How policymakers and market participants navigate these challenges will determine the shape of the global economy in the years to come.